All right, let's get into this episode 326, Income Riders on Annuities. You know, it's been said in real estate, it's all about location, location, location. Well, when it comes to retirement, retirement is all about cash flow, cash flow, cash flow. You can have all the net worth in the world, but if you don't have income, you don't have retirement. And so we want to explore all of the different ways we can produce cash flow and income. One of the ways that we need to talk about are annuities. And you'll remember from episode 322, I gave an overview of using a single premium immediate annuity for guaranteed income. It's been said that time and uncertainty are the great retirement risks. And so ultimately, what we're trying to figure out is how can we dampen these risks? How can we have more confidence as we're getting ready to make this transition into retirement, especially in a yield-starved world? You know, with the 10-year treasury, you got to think about that. You lock your money up for 10 years right now in 10-year treasuries, and they're paying less than 1% per year over that 10-year period of time. In this yield-starved world, the question becomes, how are we going to start transitioning from a lifetime of accumulation and into a lifetime of income? And one of the tools, of course, that is designed for this purpose is an annuity contract. Annuities can be confusing, and today's show is not to make a case for income riders or annuities, but nor is it to make a case against them. Really, just what I want to do is help explain them to you, because if you have not been presented with one of these ideas, chances are you will be. Maybe you already have an income rider. You're not quite sure what it does or how it works. And I find myself on the telephone with clients and insurance companies often going through a list of questions, things you should ask about these contracts, either before you purchase them or if you already purchased them. And so really today what I'm hoping to do is give you a big picture overview, but also give you the questions that you need to ask if you're thinking about using an annuity for some guaranteed income. So why are annuities so darn confusing in the first place? And one of the reasons is because there's so many different types of annuities. So at a very high level, remember, you have the SPIA, which stands for Single Premium Immediate Annuity. Think of that as a pension. Then you have a DIA, Deferred Income Annuity. Think of that as a pension that will start at some point in the future. Then, of course, you have the fixed MYGA annuities. Oftentimes, people will compare these with a CD being issued by a bank because they work in a similar fashion. A MYGA stands for Multi-Year Guarantee Annuity. It's just an annuity that an insurance carrier, insurance company offers that pays a fixed rate of interest for a set period of time. So, for example, maybe you're looking at a 5-year CD. Well, you would also maybe look at a 5-year fixed rate deferred MYGA, Multi-Year Guarantee Annuity. Very similar, but there's some big differences there as well. Then, of course, the fixed indexed annuity is a type of contract that came out in the mid-1990s. Remember, the way that those contracts work is they say you can go up with the market when it's going up, but you don't lose anything when the market goes down. But of course, they don't give you the full upside potential of the market. So that's a fixed indexed annuity. And then the last type of contract is a variable annuity. The easiest way to think of a variable annuity for most people is it is typically mutual funds. They call them sub-accounts with variable annuities, but think of a mutual fund inside of an annuity wrapper. So those are really the different types of annuities that exist today. Today's show, I really want to focus on these income riders that can be attached, and they're typically linked to either a fixed indexed annuity or a variable annuity. And what I want to do is I want to give you a big picture overview about how these contracts work. And I want to give you the questions to ask if you're considering this type of an annuity. And if you already own the annuity, I want you to give you the questions you want to be able to call your insurance company with and ask them these questions. The challenge with insurance contracts is that insurance is state regulated. A contract that may be available in one state may not be available in another state, or maybe the contract is available in both states, but the terms have to be different because the insurance commissioner of your state has to approve these different contracts. So it's very, very challenging to try to talk about annuities in a broad sense because they are contract specific, they're contract driven, and the state that you live in and the state that you purchase the contract in could have a big role to play in how that contract works. So today, I just want to clarify, I want to emphasize, we are not going to be talking about any specific company's contract. I'm just trying to give you a big picture overview of when I've reviewed these contracts, how they work, and I want to talk about the pros and the cons associated with them. There are always going to be pros and cons. Now, as we talk about annuities, I think it's fair to recognize that some people hate annuities while other people seem to love them. As a financial advisor who walks life with real people, my job is not to love or hate the financial tools that are presented to us. As a financial advisor, our job is to help you identify the pros and the cons of these different financial tools, weigh the fees and the benefits, and then help you make the best decision for your situation. So for me to say that you should always consider an annuity, or that you should never consider an annuity, or that I love annuities, or that I hate annuities, that has nothing to do with whether a financial tool is in your best interest, has everything to do with my own personal biases when giving you good advice. And one of the hardest things we will ever do is to try to view the world without our biases. In fact, I would argue that it's very, very hard to do. We all tend to see the world through a certain set of goggles. That's why we need to deconstruct these different tools and say, how do they work? What are they going to do? Is there any benefit to them? What are the risks? What are the things we should really dislike about them? And there is a lot of analysis that you want to do before you get into something like an annuity, because usually there are some pretty stiff penalties to get back out of them, and we'll talk about that. I heard a statistic once. I probably shouldn't quote it because I can't remember what percentage it was. In fact, let's just say it was a very small percentage of people who actually buy single premium immediate annuities or annuitize their contracts. That phrase, annuitize, what does that mean? Well, essentially what it means when you annuitize money is that you are turning a lump sum of money into a guaranteed income stream that you cannot outlive most of the time. Now, sometimes, as we talked about, you can annuitize for a period certain where you give the insurance company money and they're going to pay you back over, say, 5 years or 10 years or 15 years or 20 years. To really get the most out of immediate annuities, when you do the lifetime annuitization, then you get to pool life expectancy risk, and that's where the mortality credits come in, and that's where the cash flow can really look pretty attractive. However, the big downside to something like a single premium immediate annuity, the pension type of annuity, is that if you purchase one of these contracts from an insurance company, and then let's say you die 2 months after starting the income. Remember, what the insurance company is agreeing to when you purchase one of those lifetime SPIAs, they're guaranteeing that income stream will last for the rest of your life. But when your life ends, the income ends. So it's kind of a gamble in some ways. If you end up living a really long time, then the insurance company ends up losing the bet. If you end up dying early, then the insurance company ends up winning. And the insurance company can spread that risk over a large pool of people, and that is why there are mortality credits within these immediate annuity contracts. But it's also the reason that so many people shy away from purchasing guaranteed income annuities for lifetime, because they are worried that if they purchase that contract and then they get into a car accident or cancer shows up or whatever life throws at you and you die early, then there's nothing to be left for your heirs. And that's the big drawback to the immediate annuity lifetime payout. What's happened is that insurance companies, in an effort to make guaranteed income more attractive for consumers, the insurance companies have developed these income riders. And the idea was to help people have the guaranteed income that they desired without the negative aspects of the single premium immediate annuity. Of course, there's a lot of different types of income riders, and we'll touch on some of them. As time goes on, it seems like the insurance companies are making more provisions for the consumer and trying to alleviate some of the big concerns people have. And that's what these income riders are designed to do. Today, what I'm seeing in a lot of the income riders is the ability to start income without having to annuitize. And I'm going to give you a hypothetical example of this in just a minute. I will tell you, now, some of these things are not priced very attractively for the consumer.